Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. This week on the Moneymakers podcast, it's time for another catch-up with Andrew McHattie, the editor of the Investment Trust newsletter. We'll be looking back on some of the announcements of note of the last 10 days, 2 weeks period. So, Andrew, let's kick off. Of course, we've had more interventions from Trump on the tariff front, but the market seemed to have largely shrugged them off. Over here in the UK, we heard Rachel Reeves give her speech at the Mansion House dinner, and she made some announcements about potential reforms of the UK stock market. We might talk about those in just a second, but as far as she's concerned, perhaps the main story of the week has been rather disappointing economic data and gilt yields continuing to rise, or particularly any long-dated gilts are continuing to fall in price as their yields rise. And I worked out that roughly half the gilts in issue now yield more than 5%, which is a big threshold, if you like, for equities to beat. So let's kick off then. Let's talk about Rachel Reeves, first of all, Andrew. A number of announcements she made in this speech. But so far, I think the general market reaction has been rather muted. Would that be fair to say?
I think that's a reasonable assessment, yes. I think the government has been saying a lot of good things about the markets, and it's clearly very keen to support the idea of equity investment. It wants the London stock market to thrive, and it wants British investors to participate. But actually, in the terms of the practical support it's willing to give, then that's a bit more vague. We did have one interesting innovation, or change rather, which is significant, I think, for the investment trust industry, which is a shift in the prospectus rules. And I think that's probably the biggest element of what's actually occurred here. There's not too much detail here, but essentially what the government is doing is making it easier for investment trusts to raise more share capital, and that has to be a good thing. And often, of course, we talk about IPOs, but secondary fundraising from existing trusts is often more significant and arguably more important. So anything that makes that easier has to be a good thing. So in practical terms, what's happened is that previously, if a trust wanted to raise more than 20% of their existing share capital, then they had to go through the quite enormous trouble and expense of issuing a prospectus to investors. But now that threshold has changed very significantly. So in fact, they can double in size now. They can issue up to 100% of their existing share capital without a new prospectus. And that, I think, will be very helpful. I'm not sure it's going to usher in a new wave of capital raising, but if it's reducing costs and making things simpler, and perhaps also helping retail investors to get involved, then it has to be a good thing.
Indeed, it does. Of course, I think that doesn't apply if there's a really significant change in the mandate of the trust. But in general terms, yes, for secondary issuance, that will be a great help, I think. Certainly save some money. That's one deterrent from doing so. And of course, not unexpected, she didn't do anything about stamp duty, where the UK market remains the only significant developed market where stamp duty is levied at a significant rate. But she didn't also make any changes to cash ISAs and do more than kind of mouth things about promoting more investment into UK equities. So I guess on balance, potentially helpful, but not immediately that significant. Let's move on then. Let's talk about the investment trust sector and what's been going on. We've had some useful summaries of what's happened in the first 6 months of the year. We're now moving into the second half, obviously. And, well, there's been an awful lot of corporate activity over that period, I think it's fair to say. We predicted that at the start of the year. I think that was quite a commonplace assumption, and we haven't been disappointed in terms of bids coming in on merger proposals or capital return. But can we put some kind of figures around those, Andrew, to give people some context about what's been going on?
Fortunately, yes, thanks to Deutsche Numis, actually, and a report they've issued on this, because you're quite right. We've been talking about all of this corporate activity and following the news flow and discussing all of the takeovers and the mergers and the wind downs and so forth. But actually, it's useful to make sure we contextualize it all properly. And Deutsche Numis have given us the data, so this is helpful. So what they say is that this year is indeed set to be a record year year for corporate activity. There is genuinely more going on. And that's not just the vast numbers of mergers and acquisitions that we've been seeing, but actually some other important elements as well, including buybacks. So we do talk about share buybacks and often discuss whether they're effective or not. But they have actually taken a real step up this year. So in fact, in the first half of this year, the amount of share buybacks in the investment trust sector is already ahead of every other year in history apart from last year. So every other full year in history. So it's a large amount. So in the first half, the buybacks were £4.6 billion, which compares to £3.7 billion at the same time last year. If you add in the £4.2 billion that's come back through tenders and wind-ups as well, that's £8.8 billion that has come back to investment trust investors in the first half of this year. So that's a lot of money for reinvestment. And on the other side of the coin, what's been issued, actually very little, of course, has been Achilles Investment Trust, which arrived. So that was a small IPO that raised £54 million. And actually, another 28 investment trusts have been issuing shares. So they've been trading at a premium, able through tap issuance to increase their share capital. So a total of £337 million has been raised in that first half. I really enjoy delving into these statistics. You might not quite have the same tolerance, but just two more, if I may. The first one is that the whole universe now, which has, of course, been shrinking, is still £175 billion. So it's still a very significant chunk of capital and an important industry here in the UK. And 2/3 of that is equity investment trusts. Now, actually, at some point at its peak, alternative assets accounted for 50% of that total, but that's now come down to a third because so many of those have wound up. The average discount finally has come in a bit. At the turn of the year, it was 16%, and it's come in on average now to about 13.5%. A lot of that narrowing has occurred in the property sector, and it's also starting to occur in infrastructure and renewable infrastructure. So quite a lot to take in there.
Indeed, there is. But it does definitely confirm what's now a well-established pattern, but it does seem to be accelerating, as you say, which is capital returned, lack of issuance, lack of IPOs anyway, but significant buybacks, and therefore a lot of capital coming back to investors. And I guess one question is, what are those investors going to do with that capital? Well, one of those parties will be Saba Capital. They have been buying more, putting money back into the investment trust market. But it'll be interesting to see whether investors generally do follow that trend, putting money back into the investment trust sector. And I would suggest that maybe we have seen a few shoots, at least a few green shoots of that happening. And in particular, in the renewables infrastructure sector, there has been a little bit of, as you say, discount narrowing. And there does seem to be some genuine evidence of some more buying there, which is helpful. I've noticed also that the shares of listed brokers have also been picking up, which is interesting. That's often an indicator of expectations of greater liquidity in the market and more activity going on. Obviously, partly that's because of corporate activity, which they get a fee for. So there's some reason to be cheerful about this story, even though we're talking about a headline decline in the size of the investment trust sector. And I guess what's going to happen eventually, I mean, I put this to you, is we're probably going to end up back where we were before the great issuance cycle just leading up to COVID, when we had that sort of bull market in investment trusts, lots of premiums appearing. 50% of the sector was trading at a premium at one point, which I don't think we'll see that again for a while. I'm sure you agree about that.
Yes, it does feel like one enormous cycle, doesn't it? And I suppose we're not going to go back to where we were during the zero interest rate period, because I think that was an oddity that's not going to be repeated, probably not in our lifetime. But certainly some of this capital is going to come back in. And of course, we're going to have fewer larger trusts. And hopefully, with some of this capital being reinvested, they'll be on better ratings overall. And I do think we're seeing some of these neglected sectors being sorted out now. So we have seen this really significant rally in the renewable energy infrastructure sector, with the discounts coming in by 9 points in the second quarter alone. And we're seeing the first glimmer, I think, of more corporate action in that sector as well. So there's quite a lot more sorting out to do before we reach a new equilibrium. But I think we can be quite optimistic about some good investment trusts being available to take us forward.
Just on that point of the renewables, the infrastructure trust, it's interesting that to a certain extent they've broken that correlation they've had for several years now with what's been happening to gilt yields. In other words, with interest rates going up, those two sectors have struggled and they've seen their discounts widen almost sort of one for one, as it were. That does seem to have been broken, and that may be because the shape of the yield curve is changing. In other words, short-term interest rates have come down a bit and they're expected to come down again. The Bank of England is expected to cut rates quite soon, but the longer term yields are going up. And when I look at the figures, I always see it's normally around 10, 15-year sort of equivalent gilts that are the ones that trade most like renewables and infrastructure. So it's a kind of balance between those short and long-term interest rates that do have an impact. But of course, markets anticipate, we know that. So it may well be that if you are buying a renewable or infrastructure trust, you're basically taking, if you like, a kind of two-way view. On the one hand, interest rates may come down, but equally, you may now get that corporate activity, which in turn may be driven by the same dynamics. Would you agree with that?
I think that's right. So there has been a bit of a decoupling, hasn't there, with interest rates, which have clearly been a dominant factor in the valuation of these renewable trusts for quite some time. But I think now you have to take into account the potential for corporate action, which is quite likely, not necessarily in the form of takeovers or mergers. I'm not sure whether that's going to happen because these are big trusts on the whole. And whilst we have seen one or two trusts being taken out, they're chunky things to digest. But I think we will see reorganizations and we will see asset sales and we'll see some changes to these trusts. And that can be very beneficial for shareholders. We've seen actually in a couple of cases specific individual discounts narrowing where there have been announcements from the boards. So, yes, there are new factors involved here.
So if you look at it from the point of view of the fund managers, for example, we finished a period of kind of asset accumulation and we're going into a period of asset rationalization, if you like, or portfolio fine tuning, which, as you say, should be to the benefit of shareholders. Well, let's talk about some of these. You mentioned the commercial property sector. That is shrunk very significantly, as we know. But in the meantime, some shareholders have had some benefit from that process. The latest example of which being Warehouse REIT, that's ticker WHR. Perhaps you can update us on what's happening at that one, Andrew.
Well, it's a really interesting story, this one. And we talked about it before because there was already a bid battle here. This is the perfect outcome for shareholders. If your trust is going to be taken away, then you want to come out at the fullest price you possibly can. And the best way of achieving that is to have more than one interested party. And that's what happened here because initially Blackstone made an offer that was recommended by the board. And you may remember this story that actually when Blackstone delved into the due diligence, they found that they couldn't quite support the valuation of one asset. So they renegotiated the price and knocked a few pence off. And the board reluctantly agreed a lower price. But this opened the door actually for a second bidder to come in, which was Tritax Big Box REIT. And they trumped the initial Blackstone offer with a higher offer, but that was a cash and shares offer. So it was a bit variable. And actually, it wasn't that much of an improvement as it turned out. So Blackstone then came back again with a higher offer. And that's the one that's currently on the table, which is 113.4 pence plus a dividend of 1.6. But the share price is actually still slightly above this for Warehouse REIT. So the shares are trading at, I think, 115.3. So the market is saying this story isn't necessarily over yet. And maybe there's a little bit of scope here for another uplift. The NAV is about 128. So you never know, a fuller price may yet emerge.
It's an interesting one, isn't it? I mean, on the one hand, we have seen this kind of activity. It is involve these commercial property trusts going out at a discount to the reported NAV. I think that's been true in virtually every case, but typically between about 5 and 10%, I think. But also the fact that, as you say, competition is very helpful. And thinking back to our friends at Hypnosis, it does seem that if you kind of tweak Blackstone's tail, they will come back again. It's a very large American private equity venture whose boss, Stephen Schwartzman, happens to be building a huge building for the Oxford University just around the corner from where I live. It's going to be opening in the autumn. I think he's put 150 million or something into that. So he's not short of a bob or two. And it does seem that with these investment trusts that if you tweak their tail, as I say, you may get a few pence more out of them, which is always a good sign that the directors are doing their job and that the market is working. Though I wonder whether you think the Tritax Big Box will come back again. I mean, the market seems to suggesting there might be room for another P or two, but it's a bit harder if you're offering cash and shares rather than just cash.
Yes, and it's hard to judge these things because we're not privy to the discussions that have taken place. But you would have to say that if you get to the point where you've made a bid already, you have a sunk cost, don't you? You've already put a lot of time and effort into all of your due diligence and all of the legal and administrative costs that go along with making that bid. As well as that, you've got a reputational element to it, haven't you? That actually you don't want to be the person who's made the failed bid. So I think perhaps this is why people do end up paying a very full price, maybe even overpaying for things because they have a vested interest in making sure they're the winner. And I don't know in this case, but the share price is indicating there's a decent chance that Tritex might come back for another nibble.
So probably it's worth putting this in context. Warehouse REIT is a classic example of what's happened in the alternative sector. I think it was floated in 2017, and then it kind of rode this extraordinary wave in 2021 when the shares went up by a significant margin, 60% or something. And since then, they've come all the way down again, and the shares have gone from trading at a premium to trading at a discount. And then now, as you say, looks like the share price is around 115p. You've had a dividend all along the way, of course, which has added to the total return. So you can't say that this has been necessarily a failure as an IPO, but it is only trading a little bit above the issue price. So most of the return you've had has come from dividends. And I think the current yield is around 5%, something like that. So how would you assess the life of this one on the London market?
Well, I suppose with all property trusts, actually, they've scribed a similar arc, haven't they? That they had their moment in the sun. And then, of course, when interest rates rose, the property sector is clearly the most interest rate sensitive of all sectors in our investment trust industry. And so nearly all property trusts found they had a very, very tough period and came all the way back down again. So I don't think you can blame the trust or the management for that. That's just the property cycle. And obviously, it depends on your timing, whether you've done well or not. But I think actually the underlying assets here are perceived as being very good. And I think it's a high quality trust. So I'm not surprised there is demand for these assets. And my suspicion is that whoever buys it will probably feel in a few years' time that they bought it quite well.
Yes, and as a result, therefore, some shareholders might have some regret, if you like, that they haven't hung on or weren't able to see the price stimulated to find enough new buyers, even though they were trading at a significant discount for quite a long time. Perhaps worth mentioning just in passing, we've talked about PRS REIT before, another commercial property trust, which has been on the receiving end of an offer, hasn't been concluded yet. The potential bidder hasn't made a final offer, but there does appear to be, at the moment, no competition for that particular bidder. The board said they had other people get in touch with them, but nothing so far has materialized. And as a result, I think the discount that one might go out at would be actually slightly larger. Would that be right?
Yes, I mean, there's no guarantee at all of whatever the demand might be when you put your assets up for sale. And of course, quite a number of property trusts have hoisted the for sale flag, and some of them have had really good bids and some haven't. In fact, some had no bids at all. And so you just have to make your assets available in the market and see if people want to buy them. In the case of PRS REIT, we're still waiting to see, so we don't know. I mean, those are rather different assets because they're UK residential assets, and maybe that's a slightly different market from the UK commercial property market. But really, I think as a shareholder in that one, you just have to sit back and wait for developments and see what the outturn is. And discounts can vary hugely when you do come out of these things. I remember Civitas Social Housing, that was nearly an 18% discount to NAV when you came out of that one. That was one of the very first trusts to disappear from the property sector. And we've had narrow ones as well. We've had ones where you've basically been paid the NAV, but I think it's very, very difficult to forecast that.
Because I think the indicative offer in PRS case is around 115p from memory, I'm talking about now. But the shares are trading at 107p. Obviously, it takes time to complete these things, even if they happen. And therefore, this is still trading now at a significant discount to NAV, about 20%, I think. Anyway, so interesting. Horses for courses. Let's move on and talk about some other activity. Let's talk about Aberdeen European Logistics Income, ticker ASLI, which is obviously another commercial property trust. What's the story here?
Well, this relates very much to what we were saying, because this trust effectively did signal to the market that it was wanting to sell its portfolio and didn't attract any buyers at the right price at all. So it took the next route available to it, plan B, which was to wind down. And actually, it's been achieving some very good prices for its assets in the market. I think actually this is an improving market, so that helps very much, because it's a tough situation for you as a property fund manager when the market knows you're selling your portfolio. Buyers obviously are in a very strong position, but fortunately here the market background is good. So actually the trust sold two German warehouses and it at a 10% premium to the first quarter valuation. It sold two more in the Netherlands at a 3% discount, and it's in discussions to sell another 15 assets. So it seems to be achieving very good prices, which is excellent news. And now that it has sold some of these, it's going to give back another £50 million or so of capital, which is its second capital return. So it's going to give back 12 pence per share. And the figures, I think, are quite interesting here. If you look at the headline figures, it doesn't look very enticing, really, because the shares have rallied nicely. They're standing at around 65 pence, and the NAV is about 71.5. So roughly a 9% discount there, which seems very narrow because there's a lot of scope for things to go wrong during their selling process. Interestingly, though, something I pointed out before, when trusts are giving money back, the mathematics works out that the discount widens. So if you take 12 pence off both sides of that, off the share price and off the NAV, then the discount widens out to about 11%. So I don't know if there's much more scope for uplift here, but I'm just pleased actually to see this working out well, because I think when trusts announce they're going to go into wind down, if you're a shareholder, very often you don't really know what to do. Should you sell out straight away, or should you just hold on and let this thing play out and hope that you're getting a return on that? That's a nuanced debate, and I think you clearly have to look at each one on its merits, but it's good to see this working out as intended.
Right, so we're going to end up there by saying goodbye to this particular trust, I think, and that's pretty clear. Another one that came to market and has not done as well as its backers would have hoped. And that will be another loss to Abrdn, of course, who've lost a few trusts in the last period. So that's ASLI. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole, and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. Let's also talk about a couple of tender offers. You mentioned the fact there's been activity not just in terms of M&A, but return of capital, and tender offers are one of the means by which trusts can do that. There have been a couple of trusts this week which have announced tender offers, details around them. Let's start off with Polar Capital Financials, shall we? Ticker PCFT.
Yes, this one I thought had a slightly surprising result actually for its tender offer, because the trust had a 100% tender offer available to its shareholders. That was a scheduled tender offer. And I thought the trust actually, which has been a really good performer, made a very strong case for investors to keep the trust going and to hang on to their shares. So I was quite surprised actually that the take-up was 43.8%, which was much higher than I was anticipating. And it meant the trust is fine. It's retained £350 million. It was quite large anyway. So it's still a decent size and will carry on. But I would imagine the managers were maybe a bit disappointed that that much money has come out, because it's been a really good trust. Actually, it's delivered on all of its promises. And I think the outlook also looked quite good there. Obviously, financials can benefit in this higher interest rate environment. But there we are. People have voted with their feet there.
I think it's worth mentioning also in that context is another Polar Capital Trust, not the technology trust, but Polar Capital Global Healthcare. That's also reached the end, has a 7-year fixed life, and is bringing forward some proposals for a corporate reorganization this year. And it's likely that they will be offered a cash exit as well. So that does seem to be the policy of Polar Capital. And given that particular case, Global Healthcare, there's Rathbones and Investec have about 15%. So they may well want to realize some of that following their merger. So another trust has obviously suffered recently from being in a sector that's not very popular, healthcare, that is. So let's move on. We also can talk perhaps about Saba Capital. We mentioned them before, of course. They've popped up again on another register. And which one is that? And let's perhaps have a quick resume of where Saba is at the moment.
Well, that's quite a big question there. I'll try and provide a reasonably concise answer. So Saba, I think, has refined and adapted its approach. And it's become much more of a traditional arbitrager now, I think, where it's taking positions in what it perceives to be undervalued assets. Its existence then tends to agitate for change, and hopefully it manages to engineer some kind of exit which gives it a profit. So it's not seeking to take over management contracts anymore. It's not necessarily seeking to wind trusts up. It just wants to get in and out. And it has quite a large number of stakes across the sector, some of which are quite surprising. And size is no longer a defense. Saba really does have quite a big war chest here. So, for example, in the sector you just mentioned that's very much out of favor, Worldwide Healthcare Trust is on its radar, and Saba has taken a 5% stake. And that's a big trust, so that's maybe a bit surprising. But the one I particularly noticed is that it's raised its stake in Brown Advisory US smaller companies, where it's taken a 10% stake now. It was 5 and it's doubled it to 10. And to me, that trust does look rather ripe for the picking. The shares there are on a 9.2% discount, so not super wide, but nevertheless, there's a bit of margin there. And I think this trust has a pretty uninspiring performance record. The managers took over in April 2021. But if you look at the 3-year NAV return, it's 6.5% in total over the 3 years, which I think is pretty poor, actually. This trust also has some events coming up. So it does have a 3-yearly continuation vote, not due until November 26, but it is on the books. And also the potential for a full exit for shareholders if the trust underperforms in the 5 years to June 2028. Now, that's some way off. But currently, the trust is a long way behind the benchmark. And it's small as well. It only has £170 million worth of assets. So I think this ticks a lot of boxes for Saba, and I would not be surprised to see this trust disappear.
Right. Obviously, smaller companies have been quite out of favour for a while. It may have been one factor. But the broader question is whether the market over here actually needs a US smaller companies trust. There are others that do invest down the market scale in the US, and it's quite small, as you say, and also very easily realizable. I think that may be another factor here. So it's the kind of thing that traditional ARBs would like. They can hedge their market exposure. So it seems like a very obvious one. And it's trading, as you say, just around a double-digit discount. So maybe that one is going to be not with us for the long-term future. Finally, perhaps, Andrew, we might just have a mention around a trust, which I did a little video about last week, and that is MIGO Opportunities, where there's been an interesting development there. Perhaps I'd get your comments on that as well. This is a trust that recently migrated from Premier Miton to Asset Value Investors, a much larger business, which specializes in discount, arbitrage, and activism. And they're making some changes to the way that this particular trust, which is something of a private investor favorite, operates. Is that right?
Yes, I think it's an interesting one to talk about. And clearly the managers have been busy then, haven't they? Because they came to see me as well. So there we are. We've spoken to them. It's interesting, this one, because it invests in other investment trusts and therefore they're a key investor in our sector. We want to have a look at what they're buying, what they're doing, how they're involved. And they are changing their tactics here. And I think this is partly due to the move to AVI. And it's partly a sign of the times, actually. This trust, which has in the past held a pretty diversified portfolio of maybe 40 different investment companies, is now seeking to have a much more concentrated approach to narrow that to 10 to 15 holdings over time and to become much more activist rather than just sitting back and waiting for things to happen. So that's a real shift, actually. Although I must say, Charlotte Cuthbertson, one of the two co-managers, was keen to emphasise that it's not a sea change, it's really an evolution. She did say she wasn't going to be charging into any boardrooms with a machete, so that's good to know. But it's going to be interesting because I think MIGO is going to buy more of some of the trust it already owns, and it's going to sell some of the smaller holdings, perhaps. So there could be some quite significant transactions going on that may affect prices. So it's an interesting one for us to look at and talk about. The key sense I got from my meeting with them was that they're going to be concentrating more on the alternative sector rather than equity investment trust, because that's really where the wide discounts have persisted and where they see more opportunity, I think, for gain.
And it's also, I think, interesting they do. I thought two other aspects of that announcement. One was that they've putting in place a mechanism whereby if the trust gets beyond a certain size, 150 million, I think, they will then offer shareholders a redemption opportunity in order to keep it at that size so that it can continue to hold significant stakes in its chosen 10 to 15 holdings. That's something which I think one of the microcap trusts has done already, and that seems to work quite well. And secondly, they're also reducing their fee but introducing a performance fee, which is a sort of against the trend of recent times, where many boards have been persuaded to drop performance fees or to negotiate away a performance fee. Do you think that makes sense in this particular case? I mean, the annual manager fee, I think, is coming down to like something like 0.3 or 0.35. And so they won't actually be making a lot of money out of it. Given the size of the trust, they're not going to make a huge amount out of the annual management fee. But do you think that's a trade-off? I imagine they've discussed that with shareholders, so I imagine the shareholders are probably fine with that. But what do you make of those two changes?
Yes, I think it's worth talking about both of these structural changes because they're interesting. Let's start with the fees. And yes, depending on who you speak to, you're going to get a different view on performance fees. Some people love them, some people hate them. So in this case, I'm sure you're right that shareholders have been consulted and given MIGO the green light here to change it. And I think the shift actually to having a performance fee here speaks to the opportunity set. And I think the managers feel they're going to do very well and make a lot of money. And so that's why they wanted to make this shift. And I would tend to agree with that. I think they're in a sweet spot here where there's a lot of value still to be gained, I think, in these second line trusts on very wide discounts. So I think it makes sense for the managers and for shareholders. Well, I think as long as the performance fee is structured properly, so there's a cap on it, and I'm not sure actually what the fine details are in this case. If there's a cap on it, then it's fine. I think there have just been one or two egregious examples in the past, Chrysalis Investments being an obvious one, and further back, Henderson Technology Trust, where the managers have really reaped huge benefits from a big 1 year gain in their portfolio and subsequently lost money for shareholders. So I think as long as you guard against that and you have a decent high water mark, etc., then that's fine. On the other elements about capping the size of the trust, this is so interesting. In this case, the size has been capped at £150 million, really because the managers think that's the optimal size. And if the trust grows any larger than that, then they won't be able to invest in an optimal way. So, to my mind, it's absolutely wonderful that they're putting this cap on because they're recognizing that they don't want to damage their future performance just to take in a few more fees. And this has worked actually quite well for the investment trust you mentioned that has done this before, River UK Microcap. And they, in fact, have a cap on that has been hit, I think, 3 times in the past. So they've given money back to shareholders. And the really important point here is that, of course, they're giving money back to shareholders at the right moment. So they're not pursuing the policy that I hate of slicing off your capital every year and giving it to you as a dividend, but they're waiting until they've had a really strong period of performance and then giving you money back, hopefully at the top of that cycle, and you can reinvest it elsewhere in different sectors. So I like that policy. I think it's a very honest and transparent policy, and I'd like to see more trusts think about that where it's relevant. So it's really relevant for small cap trusts.
Indeed, I think it's an interesting development. This is a trust I've owned myself in the past, and I think it's created an interesting opportunity. I shall certainly be looking at that one again myself. One other thing we might talk about, Andrew, is what I would call an ongoing saga, if you like, in a way, which is what's going to happen to some of these trusts, the Baillie Gifford Trust in particular, but others as well, which have private holdings where there's always speculation about when rather of their biggest holdings is going to come to market, where there's going to be an IPO and they're going to be able to realize the value of these things. A couple of examples, one very much in the news is SpaceX, and the other is Starling Bank. Now, perhaps you could tell us about the trusts that are affected by the fate of those two particular private businesses that have been backed by venture capital and private equity over the years.
Yes, for some time, I think investors have taken the view that having these large private holdings in investment trusts has been a headwind. It's been a negative because you haven't had the liquidity and transparency, and investors have been worried about these holdings. But I think we're perhaps getting to the point in the cycle where it could become a tailwind again, and that could be very beneficial. So let's have a look at these. So SpaceX is a big one for these Baillie Gifford trusts. And I think there was some news here that was reported on Bloomberg that there could be a new round of fundraising at SpaceX, which would increase its valuation from 350 billion US dollars. That's a large number, isn't it? To 400 billion US dollars. And this would be a significant increase in the valuation, which could then benefit a number of investment trusts. So the biggest one of all, Scottish Mortgage, has a 7.2% holding. So 7.2% of its assets are invested in SpaceX. So this is a very significant holding for them. Also, Edinburgh Worldwide, SpaceX is 13.4% of assets. Baillie Gifford US Growth, it's 11.1%. And the Schiehallion Fund, it's 9.1%. So in all four cases here, SpaceX is a really important part of their portfolio. So an uplift in the valuation would be very well received. There are a couple of other trusts, Monks and RIT Capital, that have a small holding as well. And then we've seen something a bit similar with Starling Bank, which has been in the news. And I think this relates to what we were saying earlier about how the government would really quite like to back the London Stock Exchange, but seems at a bit of a loss as to ways it's actually going to do that. So it actually hasn't really done anything. Because, of course, more companies are thinking about listing elsewhere because they get a higher valuation. And Starling Bank, according to newspaper reports, is considering a US listing because they get a higher valuation in New York than they'll get in London. This is some way off. It's not going to happen this year, but I think it just focuses attention on the potential value of Starling Bank, which is also expanding in the US, really to work on a proving ground for its digital platform. And Starling Bank is very important for Chrysalis Investments, where it's actually 32% of the portfolio, so a really chunky holding. And we've seen shares in Chrysalis actually move up quite nicely this week.
It did indeed. The shares of all those trusts you mentioned, I think, moved higher this week on that news. I guess perhaps the only kind of question mark around that is we've heard the news that SpaceX is going to invest $2 billion into Elon Musk's AI venture. In other words, he's treating his son of companies as banks for his other companies. And perhaps that's something that investors don't particularly like, I think. But AI, of course, is very much in the news at the moment, and something of an arms race going on, and he's joining it in a significant way. So I'm interested to see if that has any impact on the funding or the future path of SpaceX. But as you say, for the moment, those press reports are helping the share price. I guess one should only add the caveat that press reports aren't always accurate, and you have to understand why they may suddenly have appeared at a particular junction. It may be part of a campaign to raise more money. So that brings us to the end this week. Thank you so much, Andrew, for your insights as always. And we go into the quiet summer months now, when markets often get quite volatile. But we'll look forward to getting through that and seeing what the second half of the year brings. Hopefully it will be as good as the second quarter for investment trusts, rather than as behave the same way as in the first quarter when things were a little rough.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.